You may learn about investing and how to make the best financial decisions for your life on Investor Facts. Make sure you click the subscription button and enable the notification bell if you haven't already. Share, like, and comment. Netflix just reported after hours earning, and the stock is up to 14% since then. Since short sellers are being crushed, this is obviously crucial for Netflix shareholders, but it's also crucial for bulls in the larger market. After a highly erratic session, the QQQ index is currently up more than 1%. Their true message to stockholders is that they want to concentrate on revenue and profit rather than subscription marketing. We'll get to that in a moment. When you look at this company, you can actually see a decline in subscriber numbers because it went through a period of fast development before beginning to plateau. So you notice a slowdown in growth and fewer new customers. So the market took notice, responded, "Is this stock growing? A value stock, is it? What do we value there? What is the worth of this business?" Similar to Meta, they are pivoting, and you have to try to determine what is going on. Will this be successful in the long run, or will it continue to slow down? This financial report highlights Netflix's positive side, demonstrating that the company is actually making some headway. They're concentrating on other things like offering additional packages, which will effectively let you receive Netflix with commercials and provide you with options when it comes to a subscriber base. As a result, they're really seeing subscription growth pick up again. Additionally, it will increase Netflix revenue and allow for slightly different forecasting. Netflix will aim to refocus its attention back on revenue and profitability by ceasing to forecast customer additions every 3 months. In a letter to shareholders, they made this argument. They generate $5 billion in revenue, while some of its rivals are losing money. The company has an operational profit of $5 billion. They kind of made fun of Amazon Prime and some of the other rivals here. Now, the question for Wall Street is, even if Netflix asks investors to shift their attention elsewhere, listen, will you? Wall Street, will you listen? Is this the last squeeze before it fades, or will it rise even further? And after looking at the chart, I'll let you know where I believe the stock may go. Here are a few quotes from the letter that illustrate how revenue is becoming our main top-liner metric. As we create additional revenue streams, like paid sharing and advertising in 2023, where membership is just one element of our revenue development, this will become extremely crucial, although they won't anticipate the future. Netflix will continue to provide forecasts for revenue, operating income, operating margin, and net income, traditional measurements of profitability. They will also continue to publish subscribers' ads on a quarterly basis. In other words, they won't provide you with information on the subscribers or what they anticipate receiving in the upcoming quarter, which, if you are a shareholder, is a significant change. Now, theoretically, the upcoming crackdown on password sharing and Netflix advertising tier should substantially revive subscribers' growth. You should feel more energized as a result. And we noticed that they added 2.4 million new customers today. I'm actually not a Netflix subscriber, making me one of the few individuals on the planet Earth. But the consensus was closer to 1 million, so they totally hammered it into things like Stranger Things 4, when they've had some other series. It appears that, while I have many of the other ones, I do not have Netflix. It states that quarters with 10 million or more subscribers ads may be considered relics of the past. It's possible. We'll have to wait and see whether it does. In contrast to working in a world where we are many similarities to a pandemic age driven by rapid growth, this is crucial here. Here, they want to concentrate on a streaming service that generates revenue. They are changing their focus from growth at any cost to how to turn this company profitable. It's a significant issue that is crucial. Building a sizable, successful streaming business is challenging. According to our best estimation, The total annual direct operation losses for the composite contests amount to a net loss. With the competition being targeted, this year's total could surpass $10 billion as opposed to Netflix's operational profit of $5 to $6 billion. In other words, Disney, Warner Brothers, Comcast, Paramount, and others seeks to develop successful streaming business but haven't yet succeeded, whereas Netflix claims to have done so. This is a clear competitive advantage for Netflix. In contrast to subscriber ads, where Disney, as Netflix acknowledged, might get there through consolidation and price increase. Disney Plus has the advantage because it was introduced in 2019, which is earlier in its growth cycle. Last quarter, Disney added 14.4 million new Disney Plus subscribers, while Netflix lost 970,000. Again, the stocks are up over 14, and Netflix has stated that it will attract 4.5 million new subscribers in the upcoming quarter. Netflix claims that we're not supposed to be focusing on it anymore, despite the fact that they are not providing us with forward data. Investors, pay attention as we take a closer look at a few other factors. Let's examine the valuation and the metrics. Starting November 3rd, which is not too far away, they're going to have an ad-supported tier for $6.99 a month coming to Netflix. Let's see whether this stock is a purchase, and let's see what it might do for the larger market. On Thursday, Netflix revealed its plan to launch its own version of an ad service for $6.99. This basic option will join the 3 currently available ad-free plans. Standard plan costs $9.99, $15.49 for standard, and $19.99 for premiums. According to Netflix, the basic commercials plan will include up to 4 to 5 minutes of advertisement on average every hour, which seems like a lot. The duration of advertisements, which sometimes play during programs or movies as well as before them, ranges from 15 to 30 seconds. For me, that's a big no, but maybe it's alright for you. Netflix will not allow advertisement for smoked goods, firearms, or political or policy causes. This shareholder letter is short since we had great success in TV and movies in Q3 with Monster, The Gray Man, and Purple Hearts, as well as commercials in 11 other nations including Canada, Australia, South Korea, the United Kingdom, France, and Germany. The fact that Netflix has better engagement than any other streaming service with an opportunity for expansion is therefore interesting. Netflix accounts for 8.2% of video viewing in the UK, which is 2.3 times more than Amazon and 2.7 times more than Disney+. 7.6% of TV time in the US is accounted for by Netflix, 2.6 amp by Amazon, and 1.4 by Disney+, Hulu Plus, and Hulu Plus Live. Our rivals are spending a lot of money to increase subscriber engagement, but scaling a big, successful streaming business is challenging. In other words, we are pretending that we are successful and you're unsuccessful. With total operating losses of well over $10 billion by 2022, we believe they are all in the red, as opposed to Netflix, which expects to have $5 to $6 billion in yearly operating profit. You can see some of the data here, but year-over-year growth with premium streaming subscribers worldwide is 9.4%. There, you may examine the additions, the free cash flow, and the other information. Right now, folks, Netflix is trading from an evaluation perspective. The 52-week period decreased to 162. If you purchase this at 162, you should be quite thrilled because it actually costs $275 after hours. If you pay the hefty price of $700.99, you're not at all happy. So, as you can see on the chart, it peaked at over $700 back in late November 2021 and then plummeted precipitously to 161, which is quite a distance from the bottom. So the question is it still a purchase of $109 billion large cap? According to the fast stats for these individuals, Google has a P ratio of 21.42, which has an attractive $107 billion market cap and generates a sizable amount of revenue for that market cap and value. Let's take a look at a chart, shall we? On this chart, inner $700.99 peak out and appears to have fallen off a cliff on November 18, 2021. It did make lower, higher lows. I believe you should say 162 to 169. You can see it made higher lows. It's heading up. However, there are some large gaps here which are not healthy at all, and it bounces off this S2 for $212. You can see that the current postmark is $275. This blue moving average line will likely encounter minor resistance around or near $292 and then encounter significant resistance at or near $300. Personally, I'm not sure if I would pursue that $275, even though you might argue that it is still desirable and that there may be some possibility for this one if you're looking long term. If you're a long-time investor and you truly believe in the firm, I think you should kind of wait and let it cool off because it might fall back a little bit with that set. It might not be horrible, but it would have been a lot. And you'd know better to buy it back at 212, 167, 170, and so on. I personally will be monitoring this one from the sidelines and I hope it succeeds. It might really be highly optimistic for the overall market, in my opinion. You can see that the QQQ is currently up in the pre-market. Let's take a brief look at this. The last time I looked, it was up approximately 1%. So, the QQQ is currently up 1.27%. The market will benefit greatly from this news because tomorrow will bring about some significant earnings. In my opinion, you probably already know who they are. Major EV companies and huge semiconductor companies. And every single earning report will be significant. Of course, the bears will tell you that we have to go lower. And if earnings come in worse than expected, you're going to see headline news and volatility. The more earnings that we continue to beat, the more the bulls have to kind of stand on that we've already seen a bottom and that we're going to go higher. According to my assessment of the market, there is an unquestionable possibility for growth between now and January. Is that going to last? I wonder. Should we expect new lows? Possibly in 2023, though I don't have a crystal ball. As a long-term investor, I buy high-quality equities at prices that involve some dollar cost averaging, and I advise you to do the same in a bear market. Wealth is generated on the other side of a bear market. It is generated during the bear market and realized during the bull market. Thanks for watching the entire clip. If you like it, kindly let us know by hitting the like and subscribe buttons. Also, don't forget to enable the notification bell so you can be the first to know when we post a new video. In the following video, I'll see you. Goodbye.